You hand your friend a crisp $100 bill today. He promises to pay you back $1,000, but in 30 years. You'd probably laugh in his face, right? Something feels obviously wrong about that deal, even if you can't quite explain why. And that gut reaction you're having? It's actually one of the most important financial concepts that exists, and most people go their entire lives never fully understanding it. My name is Zach, and I help people understand money, financial psychology, and the invisible forces quietly shaping every financial decision they make. What I want to talk about today is something called the time value of money. Why a dollar in your hand right now is genuinely worth more than a dollar you'll receive in the future, even if the future dollar is technically a bigger number. Because once this concept clicks, it changes how you think about everything. Savings, debt, investments, salaries, retirement, all of it. Let's start with the most obvious reason: inflation. You've heard the word, but let's make it real. In 1990, you could buy a movie ticket for around $4.50. Today, that same ticket costs $13, sometimes more depending on where you live. The movie didn't get 3 times better. Your dollar just got weaker. Every single year, the purchasing power of your money quietly erodes. On average, inflation runs around 3% annually in the United States. That means $100 today will only buy you about $97 worth of stuff next year. And in 10 years, that same $100 has the purchasing power of roughly $74. You didn't spend it, you didn't lose it, it's just worth less. Time literally steals value from your money while you're not looking. But here's where it gets really interesting, and this is the part that blows most people's minds. It's not just about inflation, it's about opportunity cost. The money you have right now has potential. It can do things, it can grow. And every moment it's not working, you're losing that growth. Think about it this way. If you take that $100 today and invest it in a simple index fund averaging 8% annual returns, in 10 years you've got around $216. In 20 years, almost $466. In 30 years, over $1,000. From a single $100 bill that you basically just left alone. So when someone promises you $1,000 30 years from now, they're not actually offering you more than your $100 today. They might be offering you less, depending on inflation and what you could have done with that money in the meantime. Your $100 today, given time and a decent return, could match or beat that $1,000 promise. That's not magic, that's compound growth doing exactly what it's supposed to do. Now let's flip this around, because this is where most people get themselves into real financial trouble. If money today is worth more than money tomorrow, what does that mean for debt? Everything. When you borrow money, you're essentially receiving future value at present prices. The lender is giving you purchasing power now, and you're promising to pay back more later. That's the deal. And it seems reasonable on the surface until you actually run the numbers. Let's say you put $3,000 on a credit card with 22% interest, completely normal for American credit cards right now. You make minimum payments of about $60 a month. You know how long it takes to pay that off? Over 6 years. And you know how much you'll actually pay back? Around $4,300. You borrowed $3,000 and handed back $4,300 for the privilege. The credit card company understood the time value of money perfectly. They gave you something now and collected significantly more later. That gap, that $1,300 difference, is the price you paid for having the money today instead of waiting. And this isn't just credit cards. Car loans, student loans, mortgages, they all work on the same principle. The lender always wins on time value. Which doesn't mean borrowing is always bad, but it means you should always understand what future you is actually agreeing to pay. Here's a thought experiment that makes this uncomfortably clear. Let's say you're 25 years old and you get a $5,000 bonus at work. You've got 2 options. Option 1, you spend it on a vacation. Great memories, beautiful trip, absolutely zero financial regret. Option 2, you invest it and leave it completely alone. At 8% average annual return, by the time you're 65, that $5,000 has quietly grown to just over $108,000. One decision at 25 years old is worth over $100,000 at retirement. That's not an exaggeration, that's just math. The $5,000 you have today is worth dramatically more than $5,000 you'd have in 20 years, because time is the engine that makes money grow. This is why financial advisors sound like broken records about starting early. It's not motivational fluff, it's math. The difference between starting to invest at 25 versus 35 isn't 10 years of contributions, It's potentially hundreds of thousands of dollars in final wealth. Because those first 10 years of compound growth are the most powerful ones. Every year you wait, you're not just missing 1 year of returns, you're losing the returns on those returns and the returns on those returns. It stacks, it compounds, and it works just as brutally against you in debt as it works beautifully for you in investments. Let me give you another angle on this: salaries and raises. Most people think about a raise in terms of what it means for their monthly take-home, but the time value of money says your raise is actually worth more than the raw number suggests. Say you negotiate a $5,000 annual raise at age 30. Over a 40-year career, that's an extra $200,000 in earned income, assuming nothing changes. But that's not accounting for the fact that you'd likely invest some of it, or that future raises often build on your current salary. A raise negotiated today could realistically be worth 2 or 3 times its face value over your working life. The money you capture now has more time to compound, more time to work, more time to grow. And here's the uncomfortable truth that most people don't want to sit with. Every financial decision you make is a time value decision, whether you realize it or not. Every purchase on credit, every year you delay investing, every raise you don't negotiate, every emergency fund you don't build, all of it has a time value component. The money you spend today can't grow. The debt you accumulate today grows against you. The investments you delay today lose compounding time they can never get back. The reason this concept matters so much right now in the current economic environment is that inflation is something people are actually feeling. Groceries cost more. Rent costs more. The invisible tax of inflation isn't invisible anymore. It's showing up at the checkout line. And that makes understanding the time value of money more urgent than it's ever been for regular people just trying to get ahead. So what do you actually do with this information? A few things. First, if you have high-interest debt, paying it off is one of the best investments you can make. Eliminating 22% credit card interest is a guaranteed 22% return. Nothing in the stock market can promise you that. Second, start investing as early as possible, even small amounts. The $50 a month you invest at 25 will outperform the $500 a month you invest at 45 in many scenarios, purely because of time. Third, think about big purchases differently. That $400 impulse buy isn't just $400. It's whatever that $400 could have become over the next 20 years. None of this means you should never spend money or enjoy your life. That's not the point. The point is making these decisions consciously, with a clear understanding of what you're actually trading. Because every dollar has a timeline, and where it sits on that timeline determines how much it's really worth. Your $100 today isn't just $100. It's everything that $100 could become if you give it time, direction, and a little bit of patience. That's the whole game. And once you see it that way, you'll never look at money quite the same again.